Is my money safe? This question weighs heavily on the minds of numerous bank customers in light of the current global banking crisis. The shocking collapses of Silicon Valley Bank, Signature Bank, and Silvergate Bank, along with the takeover of Credit Suisse, only exacerbate these concerns. Although the issues plaguing the Swiss bank differ from those that brought down the US regional banks, the situation remains alarming. Be sure to watch this video in its entirety, as you may be stunned to learn that you cannot depend on the FDIC if another financial crisis occurs and your bank fails. Have you ever stopped to consider whether the FDIC possesses adequate funds to fulfill its promises? To summarize the recent global banking crisis. On March 10, 2023, a bank run on Silicon Valley Bank led to its closure by the Federal Deposit Insurance Corporation, marking the second largest bank failure in US history. Just 2 days later, the FDIC took control of Signature Bank as well. Although the FDIC insures deposits up to $250,000, the primary depositors for these banks were large corporations and startup firms, which typically held significantly more than that amount in their accounts. According to SVB's most recent annual report, American clients held a minimum of $151.5 billion in uninsured deposits in 2022. Additionally, over $13.9 billion in foreign deposits were not insured. Despite this, the government took an unprecedented measure, guaranteeing customers access to all of their funds, including their uninsured deposits. Silvergate Bank, a bank focused on cryptocurrency, became the latest casualty in the ongoing industry crisis when it announced its intention to cease operations and voluntarily liquidate. The collapse of FTX, a major cryptocurrency exchange, triggered Silvergate Bank's downfall, resulting in a catastrophic bank run. The bank's failure was primarily due to its connection to cryptocurrency and a significant miscalculation by its management. Is this the beginning of another Great Depression? The Great Depression, which lasted from 1929 to 1939, was initiated by a string of bank failures. To address the banking crisis of that time, the Federal Deposit Insurance Corporation was established in 1933. Many economists and historians argue that the type of bank failures experienced prior to 1934 are highly improbable to happen again, as the US introduced deposit insurance. The Banking Act of 1933 granted the FDIC the authority to protect consumer bank accounts via deposit insurance. However, it is essential to consider the events of 2008. Could history be repeating itself? And if so, are we on the brink of another financial crisis similar to the Great Depression? Bank failures during the Great Recession, 2007 to 2009. During this economic downturn, the number of bank failures was significantly lower compared to the Great Depression. According to the FDIC, approximately 500 banks failed between 2008 and 2015, while nearly 4,000 banks collapsed in 1933. Thanks to FDIC insurance, depositors during the Great Recession did not experience the same level of impact as those during the Great Depression. Charles Calomiris, a finance and economics professor at Columbia Business School, explains depositors nowadays never lose a cent, even beyond the legally protected deposits. When a bank fails, the FDIC finds acquiring banks and transfers all deposits to them. This occurred during the 2008 financial crisis. This leads us to the question of how secure your money is in a bank. Bank account deposits are generally safe as long as your financial institution is federally insured. The FDIC and National Credit Union Administration regulate banks and credit unions, respectively, and provide deposit insurance. When a financial institution is federally insured, money deposited into a bank account will remain secure even if the financial institution ceases operations. Your money won't disappear with the bank. Typically, the funds are transferred to another FDIC-insured bank or you receive a check. Federally insured bank accounts include savings accounts, checking accounts, money market accounts, and CDs. Individual bank accounts are insured up to a specific limit. Before worrying about your money in the bank, it's important to know that if you have less than $250,000 in an FDIC-insured American bank account as an individual, you most likely have nothing to worry about. Each bank account owner is covered up to $250,000, but if you have a joint account with your spouse, your funds are insured for up to $500,000. If you bank with a federally insured credit union, your deposits are protected by the National Credit Union Administration, just like the FDIC, and are backed by the Credit Reserve of the United States government. Deposit protection is also available to banking customers in Europe. In the UK, depositors can have up to £85,000 or $102,000 reimbursed if their bank fails, with the amount increasing to £170,000 or $204,000 for joint accounts under the Financial Services Compensation Scheme. The FSCS is funded by an annual levy paid by financial services firms, including banks. Bank customers in the European Union are guaranteed a refund of €100,000 or $105,000 of their deposits if their banks close down, under a deposit guarantee scheme funded entirely by banks. Joint account holders are eligible for a total refund of €200,000 or $210,000. In Switzerland, the FINMA regulator insures Swiss deposits of up to 100,000 Swiss francs. Where should you store your money? Jay Hatfield, CEO of Infrastructure Capital Advisors and portfolio manager of the InfraCap Equity Income ETF, advises not to withdraw all your money from a bank, but rather to ensure that your bank is FDIC insured. At this point, negligence can be extremely costly. It is crucial to have insured deposits regardless of the amount. If you have $1 million, consider dividing your money among multiple banks or 4 separate deposit accounts within the same bank to have them insured. It's a wake-up call for people to always make sure their money is in an FDIC-insured bank and within FDIC limits, as well as adhering to the FDIC's rules, says Matthew Goldberg, a Bankrate analyst. While expert advice may seem convincing and reassuring, the collapse of these banks serves as a stark reminder that systems and structures can fail unexpectedly. It's essential to stay vigilant and ensure the safety of your financial assets. The startling truth about the FDIC and your bank deposits. Are you aware that you may not be able to rely on the FDIC if another financial crisis occurs and your bank collapses? Countless US bank depositors feel secure and unconcerned, believing that the Federal Deposit Insurance Corporation will safeguard their accounts even if their bank fails. Indeed, the FDIC claims to provide such protection. According to their website, the standard insurance amount is $250,000 per depositor at an insured bank. However, the question remains, does the FDIC have the resources to fulfill its promise? In the event of a significant financial crisis, the answer is a resounding no. In August 2008, during the height of the 2007 to 2009 financial crisis, the Elliott wave theorist reported, "The FDIC is not sufficiently funded to rescue even a small fraction of America's largest banks. It has just enough money to cover the deposits of 3 major banks. After that, it becomes insolvent." Undoubtedly, this revelation would be shocking to many people. But consider this. How can a single organization insure the deposits of all banks in the country? Yet, the FDIC sticker displayed on the front of your bank seems so reassuring, and your banker's explanations regarding deposit insurance can be very persuasive. A less reassuring statement comes from the former vice chairman of the FDIC himself. In an article he wrote for the Los Angeles Times on December 18, 2014, titled "FDIC Can't Finance a Big Bank Bailout Without Taxpayer Support," he revealed. In case you've forgotten, during the 2008 financial crisis, Congress had to pass a special law to fund a $700 billion bailout. The Federal Deposit Insurance Corporation did not have anywhere near the resources necessary to finance their resolution. Considering that the 8 largest US banks now hold approximately $11 trillion in assets and $4 trillion in derivatives, they are significantly larger and possess far more derivatives than they did in 2008. Compare those numbers to the $54 billion FDIC insurance fund. The banking industry is one of the most crucial sectors of any economy. It is responsible for managing the flow of money and providing critical financial services to businesses and individuals. However, recent events have shown that even with the regulatory reforms put in place after the 2008 financial crisis, the industry is still prone to collapse. In just 1 month, several banks have collapsed, and this has raised concerns about the stability of the industry. This has left many customers wondering if their money is safe and what they can do to protect their deposits. While the FDIC does offer deposit insurance, it is not a foolproof solution, and there are still risks associated with storing money in a bank. One way to protect your deposits is to thoroughly research the banks in your area and select one whose personnel handle their customers' deposits prudently. However, as an individual, it is nearly impossible to know when a big bank is failing. To identify red flags, you will need to keep track of the bank's financial statements, regulatory filings, audit reports, and other related information. Unfortunately, most of the information that would help you accurately assess the health of your bank is not publicly available. Key information such as deposit inflows and outflows, credit losses, and funding sources are only published at the end of each quarter, and it takes less than 72 hours for a bank run to happen. In such a scenario, it is often those with access to the bank's inner records who will be the first to see the red flags and take necessary steps to protect their assets. This means that regular bank customers may not have enough time to take action before a bank run occurs. Therefore, it is crucial to keep a close eye on your bank and remain vigilant about any potential signs of trouble. Regularly checking your account statements, monitoring your bank's credit ratings, and keeping an eye on the news for any signs of trouble can help you make informed decisions about where to keep your money. In conclusion, it is essential to understand that even with deposit insurance, there are still risks associated with storing your money in a bank. Therefore, it is crucial to remain vigilant and stay informed about your bank's financial health to protect your hard-earned money. While it is impossible to predict when the next financial crisis will occur, taking proactive steps to safeguard your finances is a smart move. Enjoyed this video? Now watch this one.